You're listening to The Preferred Way, a retirement podcast brought to you by Preferred Trust Company, the preferred custodian for all alternative investments.
Thanks for joining us for another episode of The Preferred Way. Today we are talking to Billy Stearn from Accredited Investment Corporation. We're going to talk some real estate investments today, all things alternative. So thanks for joining us, Billy. We appreciate it.
Yeah. Thank you for having me. Excited to dig into some of the details and appreciate y'all.
Yeah. So y'all have become really big player in the alternative asset space. So tell me a little bit about that. Like what really was that moment that turned things around for you guys?
Yeah, it really goes back to the story of our founders, Jack Lee Arnold, who have been in real estate for 25, 28 years, and it's been really how they have, made a living and through all types of markets. And, as you're going through that in building a business and kind of just doing what they was already having to do, you start really realizing, how do we scale this? How do we get more people involved? How do we make more of an impact? It's a very impact-driven firm. First and foremost, we do believe that we are doing good by really improving neighborhoods, improving people's lives, educating us about real estate. There's a lot going on within the company. And I think the big moment for them was, how do we do more of that? How do we do more helping people build wealth skills? How do we teach the people what we've learned? How do we improve neighborhoods? And that was the formation of Accredited Investment Corp back in 2011. And then the fund that we'll be talking about later, and some of the other things that evolved out of that, has been around for over 10 years, actually, sort of back to 2014.
Wow. Yeah, so I guess maybe on that note, let's talk a little bit about the investments that are offered and the opportunities out there for investors.
Yeah, I'd be happy to. And it's very simple, but then there's nuance that I think are very important. So we have two real estate invested funds that we offer to investors. One is a Reg A fund open to anyone. You can get started with as little as $1,000. The other products are geared more towards accredited investors, typically in this alternatives private equity space. And we have Fund 2 that is open to investors from these $50,000, to initially start. We work with a lot of retirement plans, self-directed IRAs, and people that are rolling over 401ks or, comparing to what they can invest in. And then we have mortgage notes that are available as well, and maybe even partial notes, which I'll touch upon. But those generate very nice returns. You're actually like the banker backing the loan on the loan projects that people are working on in real estate. And that in a nutshell is what we offer. We offer those avenues to build wealth with us.
I think it's really important too, that first offering that you have where the minimum investment amount is $1,000. That's huge today because that gives people the ability that may have not been able to invest in the past, a way to be able to open those doors. So talk a little bit about that.
Yeah, absolutely. It is great to have that as an offering. Some people just believe you have to have so much money to get started in real estate. And in some cases that may be true, right? If you're looking for funding, we have that as well. But, people think you just have to have a lot of money to get started. If you partner with us, you're actually allowing us to professionally manage the assets. We're really focused in real estate, fixing the flips, rehabs, and we professionally manage a lot of that in-house. And then we also lend nationally. So you kind of diversify. When you're in a fund, you're not really locked into one property. You're diversified across the nation. You're allowing us to do work for you. The beautiful part of our funds, and even at the beginning fund, is that you're getting monthly dividends, and that adds up really fast. Even with $1,000, people think, well, you're not getting a whole lot of money. But I'm telling you, I've seen people that have been there 3 and 4 years, and their returns gaining on the interest within the fund, they just leave it in their gate, is quite impressive. And that's exciting for people that are just getting started.
Yeah, I think that was going to be one of my next questions is, have you seen someone start out at a lower amount and then all of a sudden, they've got this beaming success that they didn't realize, that they could have or obtain by starting out so small?
Yeah, absolutely. We do have some people, investors that if they're not accredited yet, if they're making their living, they just need to sock away some money, and they see this as a great viable opportunity compared to what's out there. We have some people that almost on auto payment are just putting in $1,000 a month. They just let that rack on. It's great if you're able to do that. I also have some other clients down, I think in Georgia, and their children are 19 years old. And as they save up money, they're paying in $1,000 when they can. Maybe it's not every month. Maybe it's just whenever they save it up. But that to me, I mean, teaching someone that young, just getting started, that's a beautiful thing. And in real estate especially, as we all know, it's where many millionaires are creative. You've got to build wealth. What better age to start at than 18?
Yeah.
Start building that portfolio.
Absolutely. We were talking the other day about the fact that, one of the things that they don't educate you in school on, and they, are the basic things about, your financial wealth and how to build that and how to be thinking about retirement. Even you have to start thinking young at 19 years old. People think, oh, I'm only 19. I don't have to start thinking about it now. But guess what? You're going to be there quicker than you know, right? And that's a huge thing to start as early as you can.
Yeah, absolutely. And I grew up in finance. I was an investment advisor, asset allocation, a Wall Street market maker and trainer. My father was a CPA, a business accountant, bookkeeping. My stepfather was a financial advisor. My brother was a trader. My mother was real estate. Everybody was in it. And I still didn't fully understand the power of starting that early. And now I tell people, either you're working or your money is.
Yeah.
So the more you can sock up, the more you get that money working for you. I had a great success story today. This woman was telling me she bought a couple of properties, and she was getting $8,000 to $9,000 a month off.
Wow.
The multi-unit property. Just thinking about that money coming in and how that's life changing for people.
Yeah. And now think about it in a self-directed IRA. Think about putting it in your retirement account, right?
Yes. Speaking about language, coming from that background of financial advice, I tell people more than ever now, because I always kind of fought the traditional system, twice and alternative.
Yeah.
I always tell people, take control. Don't just feel like you have to ride the wave of the stock market or what these advisors keep telling people. Really take control of your finances. Ask questions about what you're investing in. It should be somewhat interesting to you. You're saving all this money to find out what you're investing in and do some due diligence.
Yeah, absolutely. Yeah, we always talk about that due diligence. Obviously, the hard part of having alternatives in a self-directed IRA is it is up to you. It is up to the account owner to do their research and to make sure they're comfortable with the investment and the company that they're working with. But it's also a great tool to have as your financial strategy. And the fact that they can invest in a company with you where they don't have to put in $50,000. They can start lower in their retirement account. What we've seen a lot of people do is start from very scratch, with their first contribution, $7,000, $8,000, and then be able to make a smaller investment to then start increasing what they're earning in their retirement account.
Yeah, absolutely. There really is no bad place to start saving money. Right?
Yeah.
There really is no age or amount. I love what y'all are doing. We were very excited about these kinds of custodial relationships, but people that are proactive, like Preferred Trust, people that really care about, offering quality investments to people and really get in a position to make great decisions. That's the kind of people we enjoy partnering with and really want to, help them to be a part of that story.
Yeah, absolutely. Okay, let's talk about the mortgage notes a little bit. So tell me how you mitigate the risk a little bit, not only for the investor but the borrower, because you're working with both sides. So how do you manage that?
Yeah, that's a great question. I don't know so a lot of people in this space really do what we do comprehensively. Really looking at the entire thing, without speaking by the curve, people seeing really what's going on. I don't really understand this. I'll do my best.
Okay. Yeah.
But we originate. So we have many parts that work together, and one of them is we will work with borrowers. And a mortgage note is just like going to a bank and applying for a mortgage, except they don't really really work with you or care about you. They actually end up selling off to mortgages to make keep it by small enough rates, or they're backed by guidelines by being Freddie, and that's cool. They live it. We step in where no one else really wants to lend, and the banks don't want to lend on people that are doing rehabs, big splits, and are very successful at it. And so we fill that gap. We have loan analysts, we have loan processors, we have an underwriting team at house, and we go through our borrowers just like a mortgage was in bank. We're going to look at every deal. We are going to pull an analysis on every deal because ultimately what happens is once it's through underwriting and all the terms are accepted, we make points for inflation fees, that's that part of it. But we are going to hold that on our books first. So we are going to fund it through our funds. And that is something that we have to be willing to buy and own. And once it's paid through that, we maintain a spread and we will offer it to our client base or our private investors, something IRAs, or any investors. And we have many people that just give it by these called the TAC as part of the retirement strategy because they can get nice cheap returns.
Yeah.
10, 11, 12, some nice 14% returns. Monthly income, as long as they're paying on time and all that goes well, go within our due diligence. So, it may sound like we're working both sides, but really what we're doing is we're filling that kind of gap with all of our resources. We're funding it ourselves, and then we're offering a great rate to our investors. If they can in our diligence, so we provide them some type of GCH document. Probably this property.
Sure.
So the analysis it's gone into it. They can make a decision if they want to invest.
So do you analyze the borrower any different than you would like a big bank would?
And we have our own guidelines, sure, but it's very similar, right? I mean, we're going to invite you over to look at things, typical things that make a credit, make a borrower credit worthy, right? But we also have an education component to our company, educating people in real estate. Again, going back to the core, the impact culture to help people build wealth. We educate them as well on how to do splits, how to get it in not good 90 days, how to really, work as contractors, have all this hours lined up. And so sometimes we will give more beneficial terms to people who have gone through our education system who listen to it the right way, we pass. Sometimes we will give them preferential treatment. If we have repeat borrowers, they'll get better rates over time. And Kevin with us, we have people that have done 9+ deals with us, and they get better rates typically because we know there's a lot of trust. We know that they know what they're doing, they pay us on time, and they'll be preferential rates on our side.
Yeah. Thanks. I appreciate the detail in that. I think that's important. A lot of times, I think investors don't ask those questions, and they're not quite sure, or they're afraid to ask those questions. So we like when we can drill down to that. So tell me a little bit about market conditions and how that affects the investments that you're looking at, the new funds that you create.
Yeah, so we're always, obviously in real estate, you are a little beholden to the interest rates, right, and fluctuations in real estate. We've seen some of that gain in other parts of real estate, but it certainly slows down transaction volume if you get into 7 to where we were.
Sure.
People obviously tighten up. I mean, people can afford $800 to 7%, right?
Right.
We definitely pay attention to all of that. I think one of our strengths is that we are not in luxury. We're not in beachfront $7 billion loans trying to these pay. We are priced right. Usually it's the ugly house on the block have positive impact in those communities. And the price moves pretty frequently. So I don't know if you remember back in 2008 when it all went bad, housing prices went real bad. There were hedge funds coming in and just buying up everything.
Oh, yeah.
They're buying, I remember in Vegas. I mean, I lived there at the time. They were buying 300 homes at a time.
Yep.
At those auctions at pennies on the dollar.
Mm-hmm.
So we live in that area of appropriately priced homes and homes that you move and sell. So we're paying attention to those economic conditions, but we're also able to respond pretty quickly.
So what markets are you in? What markets are you selecting property in?
That's a great question. So in our funds, and this is how it works for both funds, whether you're accredited or not, a portion, and this is really an interesting point because I don't know that many funds that say it's just zero in on this property, they're fruit built, multi-family. place or whatever it may be, or commercial, building. But we actually focus in both funds. About 25% of our funds are going to be professionally managed by us. Yes, you major counties, the Pacific Northwest.
Okay.
The fast-growing areas of Coeur d'Alene, Idaho, and Spokane Valley, Washington. We sort of dominate that area. A lot of times we'll go to ours and we'll buy everything in ours. So you're benefiting from professional management within the funds by us and our team. We have a construction company. We don't have to turn it over. They get into market, get it sold, and you get a professional management behind you. And then the other part of it, of each of those funds, is laid down nationally to those projects in a very similar fashion. But we're diversified all over the nation. So would you see, fortunately, some of the damage just happened with the hurricanes. Florida, North Carolina, all up the East Coast. If you're very zeroed in and focused on just that area, your money's kind of frozen or tied up for a while. The benefit to someone as large as us, that we laid out nationally. So you're diversified. We're in Texas, Pennsylvania, all in different places. And we're not so impacted by one area like that.
Right. Diversification is key. That's what we try and tell all of our clients. Don't put all of your eggs in one basket, right? Yeah. So what would be your suggestion or advice to an investor who's just starting, is like, oh, they heard this podcast for the first time. They're like, oh, I haven't ever done this before, but this seems like too good to be true, but how do I get started? What would you tell them?
Yeah, I think, again, back to due diligence, I like having a conversation with people just because I have that investment background. I've been talking about asset allocation. I do hold deck of comparing us to publicly traded securities, other real estate investment trusts, and all those things out there. But to really get involved, you can be hands-on or not. If you want to be hands-on, if you come to our company, you say, hey, I want to do these applicants, or I want to be a broker and just match people up and get paid. I want to point people to you and get paid on referring no buyers to you. We'll pay everybody for just about anything. You try to do this our way, you get paid. But if you constantly want to start building wealth, then look at our Circle of Wealth Fund 3 and see how that is accumulated over time. Do your due diligence, of course. Talk to us, reach out to us, but I would suggest one of those two avenues. You're either going to be hands-on, dive in, and there's ways to make money that people don't know about, or let the professionals manage it and we'll do it for you throughout the curve to a very low reach.
Yeah, absolutely. Okay, so what do you want to tell us that we didn't cover? Is there anything that you want investors to know out there, clients know that are interested?
Oh, you could talk for another couple hours. I try to distill it down to... when I have conversations with people, unfortunately, there is pain in other real estate, or there's stress in other real estate with interest rates shoot up the fastest in our history of our country, right? There's going to be some stresses around that in real estate. So I would like to stress that not all real estate is created equal. Some people think, real estate's bad place to be right now. Well, that's not necessarily true if you look under the hood and you're talking to a company that's very well diversified, that knows how to mitigate risk, that is very prudent, that doesn't add to leverage, that doesn't get in trouble at bad times and can quickly pivot. So I definitely like having those kind of compare and contrast conversations, as well as volatility. When you're looking at volatility about investing in traditional assets and stocks and bonds, they're very volatile. I used to live in that, that area of asset management. And here, your principal is invested hard assets in real world asset, and you're really banking on cash flow. So your money's stable, and you're just kind of clip those coupons and generating that interest on your money. So I'm always available to have those conversations. Even if you don't invest in that, I'll still look at it as because I like seeing people are invested in. I have heard a lot of pain, people investing in other things. And I'm always curious to find out what they're hearing, what they're seeing. And, as the market gets a little bit wonky, if we do have a tougher recession and things do slow down after the election, we will just shine brighter. quite frankly, because we are in, again, that low priced, quick turning residential space, always in demand. And even at bad times, this is where you want it to be.
And so if we have an investor out there that wants to get a hold of you, tell us how we reach you.
Yeah, absolutely. So we make all this available, like securedinvestmentcorp.com is our website. Secured is a very strong word because actually everything we do is backed by first lien position. So we're not second lien on anything. If it all goes bad in our world, we actually
which is super important. I was just going to ask you too, when you do have those situations, you're taking back the property, then you have the property, you have that physical asset. Do you want to talk a little bit about that?
Yeah, sure. We put my contact information at the end.
Okay.
Director of Investment Management, Secured Investment Corp. Find us. We'll definitely make all that available. Like I said, I'm open to calls all the time.
Awesome.
But yeah, coming from the world of stocks, it actually was a market maker and trader. We lose everything, right?
Yep.
Latest AI stock at the wrong time, and that being just traders. You lose a lot of principal unless you wait a long time to try and get that back. Those people who have the emotional fortitude to write things down to 80% and hold on.
Yeah.
Not the right most of us want to take. Everything we do is secured in senior secured first lien position, which means just like a bank gives you back a property if you don't pay your mortgage. We're able to, hold the deed, like the first trustee on that property. If it does go bad, sometimes people get over leveraged, sometimes they get behind, they go into default. But if it actually goes into foreclosure, then we do take the property back. Really try to work with everybody not to do this, but if we have to, we assume the property and then it is ours to unwind. Mm-hmm. And quite frankly, most of the time we're either able to unwind them at a break even or somewhat profitable position because we have the ability to hold them longer, let them work to recover. Being a part of bigger funds, we can wholesale it. If it's close to us, we can rehab it, fix it up ourselves. We can offload it to an investor. There's just a whole array of things that we can do to try and turn that into a positive situation. We really do try to work hard every case to get them back on the feet. Some of the closely behind.
Sure.
But
yeah. It's nice to know everything stays with you, and like you said, it's not being pawned off to a servicing company, and it's not, everything's happening right there, which I think is important. It's hard sometimes for investors to follow all the different routes that things take sometimes, right?
It is. There's a lot to it. Like I said, I've been in finance and investing my whole life. I didn't really understand mortgage notes at all, quite frankly, before I came over here.
Yeah.
So it is, the best analogy is, we are the bank and we are funding things ourselves. And I wish people could see behind the scene to just see that nearly 90 or some people we have in our company, just the amount of volume of applications we take each week, the limited number of people that we're willing to fund that make it through. And then when they do, we're still funding 7 loans. So the amount of money in motion is really quite impressive. And it really shows the stability of the business for our company.
That's awesome. Well, thanks, Billy. I'm so glad you joined us today.
Yeah, me too. Thank you so much. I can't stress enough how happy we are to partner with Preferred Trust, great partners, and looking forward to a very long relationship with you and doing well by your customers and we just look up even growth for you.
Yeah, we appreciate it. We feel the same. Great company to invest with, so give them a shout, check out their website, and join us next time on The Preferred Way. Thanks, you guys. Have a great one.
Thanks for joining us for another episode where retirement savers meet alternative investments. Can't wait for the next episode to learn more? Visit our website at preferredtrustcompany.com.